if you wanted to be invested in real estate, why would you participate in private lending instead of just buying shares of a REIT that owns a whole bunch of real estate? Would you rather be the bank who, let's be honest, sits back, collects a payment every month in interest and some of their principal back, pretty much doesn't do anything else? Or most people think you either own it or you don't. That's it. There's only two, but you can own it, you can finance it.
Right now, there's an epidemic of gated funds, at least in Canadian REITs.
Okay, so Nick, Jeff, why would you choose private lending over a REIT? Do either of you have any experience with REITs?
I don't.
I do not.
Jeff,
No.
do you know what they are?
I know what private lending is, but I do not know what a REIT is. No.
Okay, perfect. There's going to be people that watch this that also don't know what it is. Do you, Nick?
Yeah. Real estate investment trust allows you to indirectly get exposure to the underlying assets in a fund.
Yeah, essentially, it's like owning a piece of a building or a piece of a bunch of real estate, right? So it's by owning shares. I mean, it's functionally a stock, and you're essentially buying shares, and the trust is holding real estate assets. So you essentially own a piece of a number of real estate assets. And I may be oversimplifying it. I may not be getting it entirely right, but that's the gist. Does it make sense? So the question is, why would you participate in private lending? If you wanted to be invested in real estate, why would you participate in private lending instead of just buying shares of a REIT that owns a whole bunch of real estate? And I think a lot of people, feel like we're kind of conditioned to feel like owning the real estate is better than renting it, for example, right? And so would owning it be better than financing it? Because essentially that's what we're talking about with private lending, is the difference between owning and financing. And so I would sort of pitch to you, I'm biased because I'm a private lender and that's what I like to do, but I would say I value the certainty of private lending over the volatility and potential upside of a REIT. Because it functions like a stock, it can take off. I mean, you can really hit a home run, but as you know, Nick, and I mean, Jeff to a lesser extent, I mean, he knows me, but he hasn't been on all the episodes and whatnot, heard me say this over and over again. I love the fact that in private lending, it might be the most boring investment you ever have, but it's extremely predictable. It's predictable, it's certain, it has these types of qualities about it. So you trade off, the opportunity to hit a home run at, all of a sudden 15 or 20% returns for this consistent 8 or 9 or 10% every single year, fixed returns and whatnot. Now, is there always volatility in a REIT? Not necessarily. I mean, it can be very consistent for a long period of time, but functionally, because it is affected by, it is part of the stock market, it is going to be affected by factors that would not affect you as a private lender. So, I think, Nick, you've heard me, tell this example in other, or use this example or analogy in other episodes, but if you could choose, right, to be in every transaction when someone buys a house, unless they buy it for cash, there are two parties to the transaction. There's the bank, and then there's the owner. And the bank may lend up to, I mean, what do you see, up to 95% of the value in some cases? I mean, that's how, right? Up to 95% could be financed by the bank. It could also be 50%. It could also be 30%, but it can be up to 95. And so the bank has an interest in this property and the owner has an interest in this property. And so you get to choose now, which role would you like to have? Now, keep in mind, if you're the bank, we're going to talk about the upside of being the bank, but the downside of being the bank is you have to put up more of the money in a, let's just say in a typical 80-20 situation. The owner puts down 20%, acquires the property, owns the property, but only has 20% equity in the property. The bank has put in the other 80%. So you look at it and say, well, if I'm the bank, I got to come up with that money. But if you have the money, question is, which position would you prefer to be in? Would you rather be the bank who, let's be honest, sits back, collects a payment every month in interest and some of their principal back, pretty much doesn't do anything else? Or you're the owner who put in only 20%, but manages the property, the repairs, the property taxes, pays the mortgage, has all the risk, essentially. So if you're properly protected by the collateral, the risk shifts to the borrower. And so in a private lending situation, which person would you rather be? If you were partners, if we were going to be partners in the property and we had to decide who's going to be the owner and who's going to be the lender, I know I would choose lender every day. I don't know. How do you guys feel?
I definitely choose lender.
Yeah. And like for what
Lender,
for what
sure.
reason? I mean, but all your life you've been told owning is where it's at, right? Like you should own the property. So why would you choose being the lender without hesitation? I mean, you were pretty definitive.
Well, for me at least, it's like just the involvement of it all. I mean, obviously, I'm doing it through an administrator. I mean, I'm doing it through Magnetic. Doing it on my own would be a different story. But I don't know. I've owned property, and I just prefer to play bank.
Jeff?
Yeah, I think it's everything you just kind of touched on, right? It's the property, the maintenance, the property taxes, all of the utility bills that go with it. There's a lot more expense than just the bank note, essentially, right? Like just that. So it's so much easier from an investment side of things to actually just be the lender.
Yeah, and I kind of want to be so clear too that like this isn't about saying REITs are bad, not at all. It's just that let's assume both of them are good. I think we could agree that not every year is going to be a banner year, meaning if you're invested in any stock, REITs included, every year is not going to be perfect. There are going to be some lean years. In private lending, as long as you get the collateral right and it's enough to protect you, you can essentially, with a high degree of certainty, count on very consistent returns, whether it's 8 or 9 or 10 or even 7 or 12, whatever it is, you can count on consistency more so in a private lending situation than you can in a stock-based investment. Now, again, the upside is you can really go to the moon, in a stock-based investment. Also, I would say there's more risk that you could lose money. It's easier to lose money in a stock-based investment because there's no tangible, collateral in your name and so on. You are essentially owning shares in a corporation ultimately. So again, it's not about which one's better. It's which one you would prefer based on your risk tolerance. For me, I love the slow, steady, as long as the return is enough to get me somewhere. And that's obviously a key piece. Like you can be in very consistent, very safe investments that don't yield, right? And if they don't yield, enough, they're barely keeping up with inflation. And I'm talking about things like GICs or bonds or high interest savings accounts. Very, very safe, but you're always trading off something. Whereas with private lending, I feel like you kind of get the best of both worlds. You get a yield that can really get you somewhere over a long period of time, but you also get the safety blanket of collateral that shares the qualities of great collateral. Like I would say, something like gold is great collateral. Why? It's universally valued. So wherever you are, two people look at the same piece of gold, weigh it, and it's worth what it's worth. It's pretty much the same. Now, a house, very similar. The two of us, three of us could drive up to a house and say, okay, let's all figure out what this house is worth, and go back and go away and come back, and we'd all be within a pretty narrow range of what that property is worth if we just looked at the data around it. What are properties like it sold for, and so on. That's why we love real estate. So it's great collateral, and once you have that collateral in place, and it's significant enough that in the worst case scenario, you can essentially sell the collateral and get it back, you're in a great position. So I would take that over the volatility that comes with being in any stock-based investment. But again, it's not to say one is better than the other. It's just they're different. But if you're going to participate in real estate, and I'm a big fan of real estate, I know the two of you both are as well. If you're going to be invested in real estate, the idea is to show people that you can invest in real estate in different ways. Most people think you either own it or you don't. Like, that's it. There's only two, but you can own it, you can finance it. And then financing it, for me, feels just like a smoother ride. Do you guys have any thoughts on it?
You touched on the volatility piece, and essentially that's what it comes down to. Like, do you want to be exposed to all these swings in the market? What if cost of goods or cost of servicing property go up, as we've seen in the past, 4 or 5 years? That eats into the yield of the fund, essentially, when the cost of owning the property, doubles or triples. The contractor fees go up. You kind of have to factor all that in, and it kind of complexifies the entire investment experience versus playing bank is like, the collateral kind of buffers all those shocks for you, and then you're just left with like the steady payout.
It does. And who gets paid first?
Exactly.
The lenders always get paid first. So when you think of a lender-owner relationship, the lender gets paid first, owner gets paid last. As you said, you've got repairs, maintenance, property taxes, things like that. And then when you add in being a landlord, right, it seems like even more upside because you've got income coming in on the property. But that upside can very, very easily turn to downside, right? When you have a tenant who doesn't pay, or it's hard to evict, or just you can't increase the rent as much as you want to or need to, and so on and so forth. You've got to find tenants when one leaves, and so on. So you've got a lot of variables, a lot of different risks when you're the owner of the real estate. Now, granted, if you're participating in a risk, in a REIT, you're not dealing with those things day to day, but the REIT is and can be affected by them. And I think that's what's important to realize, is that even though you're not the one day to day dealing with managing those properties, it's not just managing those properties that can be a risk when it comes to being involved in a REIT. You're also at risk of market fluctuations. So the stock market does its swings up and down, and the value of that REIT can also be affected similarly in the same way. What about you, Jeff? Any thoughts?
I was just going to touch on the landlord piece. I've been a landlord. I've had rental properties, and it can be a nightmare real quick, and it can go south real quick. And it's not the way you want to do it for sure. I'd way rather, I've done that. I've taken my money out of being a landlord and put it into private mortgages.
Mm-hmm. Mm-hmm. Yeah, it's I've heard from so many. I mean, I'm a landlord currently, but my experience has been good, to be honest. But I'm always concerned, that I think in the case of a dispute, for example, with a landlord, one of my biggest fears is that I feel like the law is slanted in the favor of the tenant. And I think it can be very difficult. You have to be very, very prepared at all times for different scenarios when you have a tenant. And that's just from what I've heard from other people. And thankfully I haven't gone through it. Have either of you had like a bad tenant situation?
I haven't.
I have where it was, it was just struggling to get payments from them, and I had to go the legal route
Mhm.
to evict them. But I was able to work with them and get them out of the property, and then I had to rehab the property to sell it. So at the end of
Yeah.
the day, when everything washes out, I hardly made any money. So
Yeah, I mean, ultimately, I think there's a lot of really successful stories out there of people, managing properties and benefiting from the appreciation of the properties, over time, the pay down of the mortgage, being partly serviced by their tenants. I mean, those can all happen. But yes, we can't forget about things like repairs, upkeep. The fact that you can redo a condo, for example, paint it, upgrade things and whatnot, and 5 years later it's out of style. It's out of date, and you got to do it again. We tend to forget, when we own a house, about things like the windows or the roof or the driveway, and these can be big ticket items. The furnace, things like that can be big ticket items. Now, granted, um, in a REIT, oftentimes the holdings are larger properties, malls, buildings, this kind of thing. And then you're layering in other risks, right? Like vacancies and things like that. So the market can really make a difference depending on the types of properties that are in the REITs. But without getting too deep into the mechanics of a REIT, or the way I wanted to position this episode was just: do you want to be the landlord or do you want to be the lender? Essentially what I want to boil it down to. Do you want to be the lender? Do you want to be the landlord? Maybe you want to be a little bit of both. But if you've never done private lending, and there's probably a lot more landlords out there than there are private lenders, I would venture to guess that if a lot of landlords who had never done private lending experienced it once, they may have a real change of heart in terms of what they want to do, because you're getting it's I mean it's essentially being a landlord without the headaches of being a landlord, ultimately, right? You're just getting a check every month. And if you don't get a check, then you've got to deal with the collateral. But there's a process in place to do that. And it's pretty straightforward. Is the property worth enough to pay what's owing and the principal and interest on the mortgage? And if it is, property goes up for sale and gets sold, and away you go. So I mean, I think if you are the type of person who values certainty over volatility, and volatility comes with a negative connotation, but there's a real upside to volatility, right? Ask anyone who's been on a bull run in the stock market. It makes a lot of people rich very quickly. So there is big upside to being involved that way. There's also upside in being a landlord if you're in the right market or the right stretch. I mean, I can think of times in my lifetime where I wish I had bought property, because the 10 years following that time, properties went crazy. Then you look at a market like right now, and I would suggest to you that a lot of people have gotten stuck, and we see that, funny enough, showing up in private lending, right? You start to see the effects as people are struggling. We just in the last few months, Jeff can tell you, we've seen so many properties that appraised, at hundreds of thousands of dollars more 2 years ago than they do today. So people who bought those properties at the top of the market, you know, um, ended up getting hurt, and the value is not there anymore. So it's ebb and flow. It's all timing. But the nice thing about private lending is it is in a lot of ways immune to those fluctuations, right? If you're playing the stock market, or you are investing in REITs, or you're investing in buying property, you really do, like, timing is a really big piece of the equation. If you get in at the right time and out at the right time, you can do incredibly well. If you get in at the wrong time and out at the wrong time, it's a really poor experience, or very, very bumpy. Whereas with private lending, it's very consistent. A lot of people ask, how is Magnetic surviving so well through some of the toughest market conditions we've seen for an extended period of time, going back to 2020 when COVID hit. We went through COVID, where people were losing their jobs left and right because things are closed, and income is a huge issue. Then we come out of that, and we end up in this ridiculously high interest rate market climate for a while. And then we end up with a severe depreciation in the marketplace, all in the span of 5 years. You say, how do you survive so well? Well, we lend money for 1 year at a time. So we're able to adjust guidelines every year. We're able to reevaluate the collateral before we lend on it for a second year. And so even if a property 3 years ago was worth 20% more than it is today, we didn't see the effect of that drop so harshly on our property because we evaluated it every year. So every loan that we make, every term that we enter into is a new 1 year term with an appraisal from the value today. And so the evidence says you can lend in pretty much any market if you keep your term short, if you keep your interest rates fair, and you price those deals and structure them to give the borrower a legitimate opportunity to exit. You come in, you get out. You come in, you get out. But it's very consistent. Again, very boring, but very consistent. And that's my opinion on the difference between private lending or REITs. Any comments?
I will say that right now there's like a kind of an epidemic of gated funds, at least in Canadian REITs right now. And the year-to-year evaluation piece that you touched on is like really key, because REITs don't work like that. If there's a major drawdown and new capital can't be brought in, and investors are trying to get out on a mass scale, like if it's a big fund, there's a lot of trouble with that as well. So that's another major difference, the year-to-year kind of reassessment of the underlying collateral.
It is. And I mean, I definitely agree. Now, to be fair, because essentially, people
private lending is not immune to gated funds. I get that. But
look, the liquidity, right? Like, there is no liquidity in private lending. So if you lend money to somebody for a year, you can't ask for it back in 6 months because the market is changing, or you get scared, which is what happens, right? The reason why funds are gated is because the fund can probably ride out the market. I think of some of the bigger ones out there. I look at them and say, well, these funds are managed very well. I'm sure they can ride it out. But why they have to gate the funds, in my opinion, is because people, like amateur investors, get scared, right, and want to pull all their money out. Now, if everybody pulls out, everybody has a problem, and so they have to protect. Now, in private lending, you can't do that. Right. So, and now people do get stuck, right? We do get stuck in loans for longer than a year. It happens. But it's rarely without the ability to reevaluate. And if a borrower can't pay out at the end of a year, you have a decision to make, right? As a lender, you can try to force a sale, but you do have to be smart about it, because if the market has shifted in a way that's going to make it very tight for you to get out, then it may be better, if the borrower is paying every month and there's no real problem, it may be better not to upset the apple cart and to just, go for another year with them and let the market turn a bit back in your favor. So, I mean, the lack of liquidity in private lending, to me, is similar to the protectionism that's required when you're running a large REIT fund. They have to be careful that because there are redemption policies, right? So people can get money out. They just have to follow whatever rules have been set out by the trust. Maybe it's they have to give 30 days notice or 60 days, or there's a limit on how much each person can take out of the money that they've invested. But if everybody acts all at once, it's going to crater the fund. And that's obviously what you were getting at. So I agree with you. I think, being able to reevaluate properties 1 year at a time is important. It's also when you own the property in a down market, it's hard to sell. Whereas even in a down market, it's, I think, easier to exit a private mortgage than it is to sell a building in a market like this.
Yeah.
So I think that's kind of what you were getting at. But there are differences. There are also some similarities, but there are some big differences. And I would agree, in a market like this, what do you do if you're holding all these properties, and now they're not worth what they were worth before? And even if you want to sell them for liquidity purposes, there's no buyers or there's no market.
Yeah.
It can be very difficult. And I would think that the net result, let's just say in both cases, the investor gets stuck. So you want to be out of it, but you can't get out.
Well, and Chris, and this also applies because we touched on this in our syndicate versus pooled vehicle episode.
Yeah.
But this definitely applies to REITs because REITs are publicly traded. And you were talking about how sometimes investors are exposed to the risk appetite of whoever's managing the fund.
Yes.
If capital is like flooding in on something that's publicly traded and that money needs to find a home, sometimes suboptimal decisions are made, to say it politely.
Yeah.
And what's cool about the syndicate model is that even if an investor has a larger risk appetite than me, he can go second position, high LTV, and I stay in first, low LTV, and I'm not exposed to other investors, the risk appetite of another investor.
Yeah, there is certainly more flexibility that way. There's no question that when you're lending for short terms, you're creating more doorways out. Now, if I had to choose between being in a private mortgage or owning property, coming into a market like we're in today and have been for some time, both can become illiquid, but I would prefer to be in my private lending shoes with that liquidity problem than to try to have to sell an asset at undervalue. See, with private lending, as long as the borrower continues to make payments, and you've heard me say this before, there's no positive correlation between the value of my property dropped and I no longer am paying the mortgage, right? So what I'm trying to say is just because the value drops, people don't stop paying their mortgage. So in a market like this where the values have softened, the bulk of our borrowers pay every month, like the high percentage of them pay every month, which allows you the runway, right, to ride out a softer market until it comes back. And what we've seen, and the reason why REITs are REITs, is because they also know that cyclically, the real estate values come back. And they usually come back stronger than they were before. It just may take a period of time. And when you've got a borrower who's paying, that you've evaluated their ability to pay is sufficient for a year, it's probably sufficient for 2. It might even be sufficient for 3. And so you can work with them. There's more opportunity to sort of stem the tide, if you will. Whereas you get in a situation where all the investors in the REIT know that all the assets in the REIT have depreciated in value. Everybody wants to jump ship. And they try to jump ship, you must gate, right?
Yeah.
So anyways, really interesting topic. And again, like for anybody who's invested in a REIT, this is not which is better. I'm more comfortable in a private lending situation. Long term, I think, the ride is going to be smoother, more consistent. We may end up at the same place, to be honest. Like if you're in a REIT for 10 or 15 years and it's a well-run REIT, you might even be ahead, but I'll take my consistent 8, 9, 10 every year, no losing sleep at night, more liquidity options in a dire situation, that kind of thing. That ride is more attractive to me. That's all.
Nope. Well,
But if you don't agree, you don't agree. And either way, we can just be happy lenders.
that's it. Until next time,
Yeah.
happy lending.